Meet Kyle, who is 30 years old and currently works hard in the busy field of marketing. Every single month, he watches his bank balance melt away much faster than he can even process. Kyle has become another victim of the survivorship bias sold by financial gurus from every screen. They tell you to just change your mindset and money will flow like a river, but mathematics says this is total nonsense. Your wealth is not a state of mind, but a pure derivative of your ability to control dopamine cycles. Kyle earns 20% more than he did last year, yet his net delta at the end of every single month remains exactly zero. This is known as lifestyle inflation, where every extra dollar of income is accompanied by a 40% increase in spending to match social status. Most people perceive money simply as a tool for consumption, but in reality, money is capitalized time with high volatility. When Kyle buys a brand new phone model on credit at a high 24% interest rate, he is not just buying a shiny new gadget. He is actually selling his future time at a massive 40% discount, which is a mathematically proven and destructive strategy. We are now looking at Kyle's wealth graph, where the top line represents his income and the bottom line represents his expenses. The distance between them is his true freedom. Gurus tell you to increase the top line, but I tell you that controlling the bottom line has 3 times the impact on your final capital due to the compound interest effect. Money psychology is 90% about managing your own internal fears and only 10% about the actual knowledge of various investment tools. Kyle thinks he is poor because he earns too little, but in fact, Kyle is poor because his capital retention rate is less than 5%. Imagine your financial system is a bucket with holes. There is no point in pouring more water if you have not first closed those fist-sized holes. These holes are subscriptions to various services you do not even use and takeaway coffee that takes 7% of your total free cash flow. They are also his constant attempts to look successful and wealthy to a group of people who do not truly care about him. Every single transaction Kyle makes is a bet in a zero-sum game against massive corporations that spend billions studying his psychological vulnerabilities. When you see a 30% discount, your brain registers a profit, but in fact, you lose 100% of the purchase amount on something you do not need. Kyle stops listening to motivational speakers and starts looking at his personal budget like the formal financial report of a major public company. His goal is to achieve a survival margin of 30%, which means 30 cents of every dollar earned must work to buy back his future time. Many people fear inflation at 6%, but they completely ignore the stupidity tax at 30%, which is overpaying for brands. The stupidity tax consists of impulsive purchases made under the stressful influence of cortisol, which cloud your long-term judgment. Kyle starts using game theory in his daily life to navigate financial traps and make more calculated decisions. He understands that every delayed purchase today is an option for freedom tomorrow, with an expected return 10 times higher than any bank deposit. We see Kyle's life changing, not because he bought a luxury yacht, but because of the complete absence of anxiety when checking his bank balance. His capital is now growing exponentially rather than linearly, gaining more and more momentum with every single month that passes. He no longer plays the shallow game of conspicuous consumption. He now plays the game of accumulating assets that have a positive correlation with global economic growth. Ultimately, the psychology of money comes down to one simple equation. Your financial independence equals the sum of your refusals of instant gratification multiplied by time. Kyle now understands that true wealth is what is not seen. It is the resources not spent that give him the right to choose and make him the owner of his own life. We are now conducting a full financial forensic audit of our hero's life. Kyle believes he controls his decisions, but mathematical analysis of his bank statements says otherwise. 80% of his small daily transactions are the direct result of hidden neuromarketing algorithms designed to bypass his logic. We see Kyle entering a local supermarket where his brain acts as a biochemical terminal under constant attack through the anchoring effect. When he sees a price crossed out from $100 down to $70, he is not saving $30. He is spending $70 to eliminate an artificially created dopamine deficit. Consider the middle-class trap called the decoy effect. Kyle chooses a middle subscription for $15 because it looks better than the base for $10 and premium for $25. The corporation does not actually want to sell him premium. It uses premium as a statistical anomaly to force Kyle to choose that middle option. As a result, Kyle overpays 50% of the cost for features he will never use, which is a pure loss of capital with zero added value. Kyle also fell into the trap of having a high income without any capital accumulation, which in English terminology is called HENRY. His income is in the top 10% in the country, but his net assets are zero because of a total lack of lifestyle risk hedging. His rent accounts for 35% of his net income, and his car loan takes another 15%. After taxes and food, Kyle has zero liquidity. From an investment banker's perspective, Kyle is a company on the verge of bankruptcy with a beautiful office and zero cash flow. Now we implement the exit strategy. Kyle begins to perceive every expense as a negative derivative, calculating the cost of a thing not in money, but in life hours. New sneakers for $200 now cost Kyle $2,000 over a 10-year horizon, when he considers the opportunity cost of investing that money at 8% annually. This paradigm shift reduces his impulsive spending by 60% in the very first quarter of his new financial life. We see Kyle building his own reservation system, creating a liquidity fund that covers 6 months of his basic expenses as insurance against labor market risks. He automates the deduction of 20% of his income into low-volatility assets, no longer trying to time the market. Game theory proves that consistency beats randomness in 99% of cases over the long run. At the 11-minute mark, Kyle has no gold watch, but he has capital that generates income equal to his rent. His confidence has increased by 100%, rooted in hard calculation rather than empty affirmations. He broke the system because he simply stopped playing by its rules, choosing discipline over the magic of success. Now we will analyze the main tool of Kyle's enslavement, which is consumer credit, sold by financial institutions as a grand opportunity. From a mathematical perspective, credit is a short position on your own future, with a deeply negative mathematical expectation. Kyle took a vacation loan at 30% per annum. This means every minute of his rest costs him 1.5 minutes of future office work. We see a graph where Kyle's interest rate exceeds his income growth rate by 15%, leading to a state of technical default. His car loses 10% of its value the moment it leaves the showroom. Kyle pays for the right to own an object that actively robs him. We introduce the concept of time arbitrage. The rich buy time while the poor are forced to sell it. Kyle used to sell his time to buy things that forced him to sell even more time, creating a closed loop with an efficiency of minus 40%. Kyle moves to positive arbitrage by closing debts with the highest interest rates, which is an investment with a guaranteed return of 30% per annum. Kyle spent 10% of his annual budget on clothing brands that broadcast success, trapped in a game of social signals to occupy a higher hierarchical step. He realizes that real capital is quiet, and those who actually own millions of dollars have zero need for external confirmation of their status through consumption. Kyle analyzes his environment and realizes that 80% of his friends live on credit, trying to impress each other in a zero-sum social bubble. When you do not depend on the next paycheck, your bargaining position in the labor market increases by 100%. Because you have a margin of safety. This is a psychological turning point where Kyle understands that every dollar he did not spend to look cool is a brick in his foundation of security. Kyle becomes financially invisible by refusing to pay for other people's expectations, and this becomes his greatest strategic advantage. Most gurus want you to visualize wealth, but I want Kyle to conduct a strict audit of his value, like a liquidator of a company on the verge of bankruptcy. Kyle introduces the rule of 25 into his life. This is not just a formula, it is his personal kill switch for the system of corporate slavery. If Kyle reduces his annual expenses by 30%, he automatically increases his capital resilience by a staggering 200%. Kyle now sees every single takeaway coffee not as a simple drink, but as a negative derivative that steals 3 days of freedom from him 10 years from now. He stopped being easy food for the banking system and became a predator in the capital market, focused on creating his own liquidity. At the 11-minute mark, Kyle closes his laptop. He did not become happier because of a new car. He became freer because his logic finally defeated his dopamine.